Hello, I'm John A.G. There are moments in markets when the price stops being information and starts being noise, and most people cannot tell the difference. They stare at the screen, refreshing the ticker, arguing about whether silver is going to 90 or falling back to 70, as if the number itself is the event. But sometimes the number is only the echo. The real event is structural, mechanical, quiet. It unfolds behind the screen in vault reports, warehouse receipts, margin notices, and contractual deadlines that most participants never read. And when you realize that, when you truly understand that the visible volatility is not the cause but the symptom, something shifts. The question stops being where is price going and becomes what is breaking underneath. Today, silver is not simply moving, it is accelerating. It closed at 84.52 on the bid after gaining 7.77% in a single session. Gold moved sharply as well, closing at 5159.0, up 222%. On the surface, that looks like momentum. It looks like enthusiasm. It looks like speculative energy flowing into precious metals. But price momentum does not tell you why something is happening. It only tells you that it is. Most viewers are asking the obvious question. Is this sustainable? Is it going higher? Is this the top? Those are comfortable questions because they assume continuity. They assume the system is functioning normally and we are simply debating direction within a stable framework. But there is a better question, and it is not comfortable. The better question is this: where is the physical silver? Not the paper contract, not the synthetic exposure, not the leveraged promise on a futures exchange, the metal, the bars, the warehouse-certified deliverable inventory that can actually settle a contract when the time arrives. Because in 5 days, the silver futures market reaches a contractual checkpoint that does not care about sentiment, headlines, or social media arguments. It cares about delivery. Here is the mechanical reality. The March silver futures contract currently carries 47,847 open contracts. Each contract represents 5,000 troy ounces. At Friday's closing price of 84.52, that means each contract is worth roughly $422,000. Multiply that by the open interest, and you arrive at a theoretical delivery obligation of approximately 239 million ounces of silver. That is the demand side. Now look at the supply side. The amount of registered, deliverable silver sitting inside the exchange warehouse system is approximately 88 million ounces. Registered silver is not theoretical, it is not eligible, it is not potential. It is the specific category of metal legally designated as deliverable against a futures contract. So we have 239 million ounces in open contractual claims against 88 million ounces of deliverable inventory. That is roughly 2.7 ounces of paper claim for every single ounce that can actually be delivered. On its own, that ratio is not unprecedented. Futures markets always operate with more claims than inventory because most participants never intend to take delivery. They close or roll their contracts before the deadline. That is the normal functioning of the system. The false comfort lies right there. The assumption that most participants never take delivery becomes a law of nature in the minds of traders. It becomes automatic. Of course, open interest will collapse before delivery. Of course, the ratio will normalize. Of course, the system will function as it always has. That assumption is the safety blanket of the paper market. But conditions are not normal, and inventory is not stable. 5 months ago, the registered silver inventory stood near 170 million ounces. Today it is approximately 88 million. That is not a one-time shock. That is not a single large withdrawal. It is a sustained drawdown that has cut the registered category in half. More importantly, the pace of that drain has accelerated. In just the past 4 weeks, roughly 90 million ounces have left the combined warehouse system. That number matters because inventory trends are not abstract. They represent physical metal moving somewhere else. When eligible silver leaves, it reduces the pool that could be converted into registered. When registered silver leaves, it directly shrinks the deliverable universe. And this is where the early value reveal appears. Futures markets function on trust and rollover behavior. They assume most longs do not want metal. They assume most shorts can source supply if necessary. But if inventory is draining, while open interest remains elevated, the system becomes dependent on one outcome: rapid liquidation before the first notice date. 3 weeks ago, March open interest stood near 425 million ounces. It has declined to 239 million. Nearly 200 million ounces of contracts have already been closed or rolled. That sounds reassuring until you understand what it represents. The contracts that left were the easiest to exit, the lightly committed participants, the traders who could not handle rising margin, the funds that chose not to endure volatility. They are gone. What remains is residual, and residual open interest after 6 margin increases is not fragile capital. It is committed capital. Margin is the exchange's primary control lever. In October, the margin requirement was $22,000 per contract. It was raised to $30,000. then to 9% of contract value, then 11%, then 15%, then 18%. At current prices, 18% equates to roughly $74,000 per contract. The cost to hold a position has more than tripled in 4 months. Under normal circumstances, such aggressive tightening would crush open interest. But even after 6 increases, 239 million ounces remain open. That tells you something about who is still standing. Margin hikes do not affect everyone equally. Large bullion banks and well-capitalized shorts can wire additional funds without blinking. Industrial users who genuinely need silver for manufacturing have incentive to maintain exposure. Funds with strong conviction and deep pockets can endure volatility. The weak hands have already been filtered out. That filtering effect is critical. The very mechanism designed to reduce delivery pressure has selectively removed the least committed participants, leaving behind those most willing or able to accept delivery. It is a paradox. The exchange tried to thin the herd. What remains may be the core. Now consider the price behavior. Silver fell sharply earlier in the month, reaching approximately 64.80 after a dramatic sell-off that included regulatory action on a coordinated trading entity overseas. The recovery from that distorted low has been swift. In roughly 11 days, silver climbed about 25% from that trough to 84.52. And this occurred while the exchange enacted its 6th margin increase. Normally, margin hikes suppress prices by forcing liquidation. But in this case, after the final hike, price rose aggressively. That suggests the buying pressure was not casual optimism. It suggests short covering. Shorts who do not possess deliverable silver face a binary decision as first notice approaches: source metal or buyback contracts. If sourcing is difficult or expensive, buying becomes the path of least resistance. And short covering does not announce itself with a press release. It appears as persistent upward pressure that accelerates as deadlines approach. Friday's 7.77% surge is not merely enthusiasm, it may be urgency. The countdown matters because of mechanics. Thursday is the final session in which a long who does not want metal can exit cleanly. After that, remaining longs are treated as willing recipients of delivery. Friday is the first notice day when shorts can issue delivery notices. Once assigned, a long must accept. Timing control belongs to the short, but obligation is absolute once notice is delivered. If open interest remains elevated heading into that window, and registered inventory continues trending lower toward 80 million ounces, the imbalance becomes visible at the contract level. Even if not all longs demand delivery, the mere possibility reshapes behavior. Shorts without metal cannot assume rollover safety. They must act before the mechanism forces them. And here is the deeper layer that unsettles certainty. The exchange cannot technically default in a traditional sense. It can enforce cash settlement if physical supply is insufficient. Legally, that resolves contracts. Practically, it signals that the price discovered on the exchange is no longer anchored to physical deliverability. It becomes a dollar settlement system rather than a metal settlement system. Confidence in price discovery is fragile. It survives on repetition of normal outcomes. If participants begin to doubt that contracts reliably convert to metal, behavior changes. Industrial users seek supply elsewhere. Physical premiums detach. Paper pricing loses authority. The next 5 days are not about whether silver reaches 90 or revisits 70. They are about whether the structural assumption underlying the Western silver futures market continues unchallenged. Inventory is lower than it was 5 months ago by nearly half. Open interest remains substantial, even after aggressive margin tightening. Prices rising despite institutional pressure. And the calendar is moving toward a checkpoint that requires real metal, not narrative. When you look at the chart, you see volatility. When you look at the warehouse data and the contract structure, you see stress. And stress does not always announce itself with collapse. Sometimes it announces itself with acceleration. The question now is not simply how high silver can trade. The question is how the delivery mechanism behaves under concentrated pressure from committed capital and declining inventory. If the slope of open interest decline slows while price rises, the covering dynamic intensifies. If registered inventory drops further, the supply cushion thins. Each daily report becomes a signal. Markets rarely break where people are looking. They break where assumptions have hardened into certainty. Right now, the certainty is that futures contracts will roll as they always do. That margin increases will cool enthusiasm. That inventory drains are temporary. But certainty in leveraged systems is often the precondition for surprise. And we are 5 days from a deadline that does not care about belief. If you step back from the daily candle and look at the structure, something subtle but important begins to emerge. The system is not under stress because price is rising. Price is rising because the system is under stress. That inversion matters. Most people interpret higher prices as excitement, as momentum, as speculation getting ahead of itself. But sometimes higher prices are a rationing mechanism. They are the market's attempt to reconcile too many claims with too little supply. The first notice date is not dramatic on television. There is no bell that rings across financial news. It is a procedural event inside a clearing system. But mechanically, it is where theory meets obligation. Once first notice arrives, the contract ceases to be abstract exposure and becomes a logistical demand. And the way participants behave in the days just before that shift tells you everything about how serious the imbalance really is. There are three moving pieces converging right now: open interest, registered inventory, and margin policy. Most investors only watch one of those. The price. Let us focus on open interest first. We know that roughly 200 million ounces of contracts have already exited the March contract over the past few weeks. That is the easy part of the unwind. Those participants had flexibility. They were not structurally tied to delivery. They could close, roll forward into May, or step aside entirely. They are gone. What remains is approximately 239 million ounces in open contracts. Now, that number will fall further. It always does as first notice approaches. But what matters is not that it falls. What matters is where it stabilizes. If it falls quickly toward 120 million ounces or below before Thursday's close, the system likely absorbs the pressure. If it stalls higher, say near 150 million or more, while registered inventory trends closer to 80 million ounces, the imbalance tightens. Here is the psychological trap. Traders assume that because open interest always declines before delivery, it will decline enough. That assumption is based on repetition, but repetition does not guarantee sufficiency. If the quality of the remaining holders is different this time, behavior can shift. And the quality is different. 6 margin increases in 4 months is not routine policy. It is escalation. The exchange raised requirements from $22,000 per contract to roughly $74,000. That filters aggressively. Retail speculators rarely survive that. Highly leveraged funds do not survive that. The capital that remains is patient and deliberate. It has absorbed volatility and additional deposit requirements without liquidating. That filtering effect creates a paradox. The exchange's primary defense mechanism against delivery stress is margin pressure, but after multiple increases, the marginal effect diminishes. You cannot filter the already filtered. If the remaining longs are industrial users or well-capitalized funds with a strategic objective, another incremental margin hike may not dislodge them. Now consider the shorts. On paper, every contract has a short seller who has promised to deliver 5,000 ounces if called upon. Some of those shorts are covered. They possess registered metal in approved warehouses. They can issue delivery notices without stress. Others are not covered. They are relying on liquidity, rollover behavior, or the ability to source metal later. Under normal market depth, sourcing metal is manageable. Eligible inventory can be converted to registered. Metal can move between vaults. But when the overall warehouse system is draining and when eligible inventory itself is being withdrawn, sourcing becomes more competitive. We also have to factor in the drawdown beyond the futures exchange. Large silver-backed exchange-traded funds have seen meaningful outflows of physical holdings. Tens of millions of ounces have left those structures recently. When metal leaves both the ETF system and the futures warehouse system simultaneously, it signals that physical supply is not idle. It is being relocated, potentially into private hands or industrial channels. That matters because eligible silver is not the same as registered silver. Eligible metal can theoretically be converted into registered status, but only if the owner chooses to make it available for delivery. If owners withdraw or hold tightly, eligible inventory becomes irrelevant to futures settlement. So the visible registered figure of 88 million ounces is the key metric. If that trends toward 80 million by the first delivery date, and open interest stabilizes above 125 million ounces, the ratio becomes uncomfortable. Not impossible, but uncomfortable. And discomfort in leveraged systems does not require a full default to change behavior. It only requires doubt. There is another layer here that rarely gets discussed: incentive alignment. The exchange has incentive to preserve orderly settlement and credibility. Bullion banks have incentive to avoid disruptive price spikes that damage short positions. Industrial users have incentive to secure supply at known prices. Funds have incentive to exploit dislocations if they believe structural shortages exist. These incentives do not align perfectly. In calm conditions, misalignment is hidden by liquidity. In tight conditions, it becomes visible. If you are a naked, short approaching first notice without secured metal, your risk profile changes daily. Each upward move in price increases the cost of covering. Each day that registered inventory declines reduces optionality. Each margin increase that failed to shake out longs reduces confidence that remaining holders will exit voluntarily. This is why price acceleration into first notice can be a warning sign rather than a celebration. If silver were collapsing into the deadline, it would signal that longs are exiting en masse and relieving delivery pressure. But silver has risen approximately 25% from its recent low, and it did so while margin requirements were tightened. That suggests the pressure is not coming from new speculative longs piling in. It suggests existing shorts are reassessing exposure. Short covering is not emotional buying, it is mechanical risk reduction. Now let us introduce the second-order effects. For 5 consecutive years, global silver consumption has exceeded combined mine production and recycling supply. That is a structural deficit. It does not cause daily volatility, but it erodes buffer inventory over time. Warehouse systems do not drain because of one headline. They drain because consumption quietly exceeds replenishment year after year. When structural deficits intersect with leveraged paper markets, tension builds slowly and then appears suddenly. The futures system can function with high claim-to-inventory ratios as long as confidence in rollover behavior remains intact. But if industrial demand is persistent, and if more participants choose to stand for delivery rather than roll, the system's elasticity narrows. We must also look forward, not just at March. The May contract already carries more open interest than March. Over 56,000 contracts sit there. That is larger than the current March figure. If March deliveries draw down registered inventory further, May will approach its own first notice period with a thinner cushion. This sequencing matters. Even if March resolves without dramatic disruption, it may do so at the cost of lower warehouse reserves. That pushes stress forward into the next cycle. Markets rarely resolve structural imbalance in a single month. They transfer it. There is historical precedent for exchanges intervening during extreme conditions. Decades ago, rule changes restricted the ability to open new long positions during a silver squeeze. That action precipitated a rapid collapse in price because the structure at the time included surplus supply. Today's environment is different. We are not dealing with visible surpluses. We are dealing with a multi-year deficit backdrop. Would aggressive rule changes suppress price? Possibly in the short term. But suppression does not create metal. It only alters participation rules. If underlying physical tightness persists, credibility becomes the variable at risk, and credibility is fragile. The exchange technically has the authority to enforce cash settlement if physical supply is insufficient. Legally, that resolves contracts. But psychologically and structurally, it transforms the futures market from a delivery mechanism into a pricing abstraction. Industrial users who depend on reliable metal access would interpret forced cash settlement as a warning. That is the delayed risk that few want to contemplate. Not a dramatic headline default, not an immediate collapse, but a gradual decoupling between paper pricing and physical availability, premiums diverging, off-exchange transactions gaining relevance, futures losing primacy as the benchmark. We are not there yet. But the trajectory of inventory and the resilience of open interest determine how close the system drifts toward that threshold. Watch the slope of open interest decline over the next sessions. Not the absolute number alone, but the speed. Watch registered inventory daily. If metal suddenly flows back into registered status, it suggests shorts are scrambling to fortify supply. If inventory continues to drain even as first notice approaches, it signals that physical holders are not cooperating with futures settlement needs. Watch margin policy. A 7th increase after 6 aggressive hikes would not be routine housekeeping. It would be a signal that the exchange perceives risk in the current structure, and watch price in context. If silver pushes decisively above 90 while open interest remains elevated, the covering dynamic intensifies. If price stalls while open interest collapses, the pressure may be dissipating. This is not about predicting a specific target. It is about observing interaction between inventory, obligation, and incentive. If you hold physical silver outside the leverage system, you occupy a different position entirely. You are not subject to margin calls. You are not dependent on warehouse categories. You are not exposed to forced liquidation due to policy shifts. The very asset that participants inside the futures structure may scramble to access is already in your possession. That asymmetry is often misunderstood. The paper system creates volatility. The physical holder observes it from a distance. We are now at the point where the calendar, not sentiment, drives the narrative. Thursday closes the door for uncommitted longs. Friday activates notice. Monday initiates delivery. Between now and then, the data will reveal whether this is a routine rollover or a structural stress test. And structural stress tests rarely announce their outcome in advance. They reveal it in behavior. The hardest thing for investors to accept is that markets rarely fail loudly at first. They bend, they stretch, they absorb pressure in ways that appear orderly from the outside, and then one day you realize that what you thought was stability was simply delayed recognition. What we are watching now in silver is not a prediction of collapse. It is a test of architecture. Every leveraged commodity market rests on a foundation of assumptions. The first assumption is that most contracts will never require delivery. The second is that sufficient inventory exists to satisfy the minority that does. The third is that margin policy can regulate participation fast enough to prevent imbalance. As long as those assumptions hold, the system functions smoothly. Price moves, volatility spikes, but settlement remains routine. The current moment forces each of those assumptions to be examined simultaneously. Start with rollover behavior. For years, traders have relied on the statistical reality that open interest collapses into delivery month. It always has. That repetition creates psychological inertia. But if industrial users increasingly choose to stand for delivery because physical supply outside the exchange feels less certain, rollover behavior becomes less predictable. You do not need a majority to stand for delivery. You only need enough. Then consider inventory sufficiency. Registered silver at approximately 88 million ounces, trending toward 80 million, is not zero. The exchange is not empty, but the ratio matters. If projected standing demand hovers near 125 million ounces, and registered inventory sits materially below that, the system becomes dependent on one outcome, that a large portion of longs voluntarily exit. And that brings us to margin policy. The exchange has already escalated margin from 22,000 to roughly 74,000 per contract. That lever has been pulled repeatedly. Each increase is a message: reduce exposure or post more capital. But when increases fail to drive open interest down proportionally, the marginal effectiveness declines. You cannot threaten capital that is already prepared to remain. Now let us reframe the real risk. The most dramatic scenario people imagine is a formal default. Contracts unfulfilled. Chaos. That is unlikely in a literal sense because the exchange has legal authority to enforce cash settlement. Dollars can always be printed. Transfers can always be made. On paper, the books can balance. But markets are not sustained by legal closure alone. They are sustained by confidence and function. If at any point a meaningful number of longs stand for delivery and discover that cash settlement is encouraged or imposed because physical allocation is constrained, the message to the global silver market is subtle but powerful. It would mean the futures price is no longer a direct proxy for physical availability. It would mean that the contract is a financial instrument first and a delivery mechanism second. That distinction changes behavior. Industrial consumers who depend on silver for electronics, solar panels, medical equipment, or defense applications do not want cash. They want metal. If they perceive delivery risk, they may seek alternative procurement channels. Physical premiums in private markets may widen. Off-exchange transactions may grow. The benchmark could begin to fragment. This is how credibility erodes, not in a single event, but in incremental behavioral shifts. Let us also consider incentives more deeply. Bullion banks that operate heavily on the short side are sophisticated. They hedge, they manage exposure, they maintain vault relationships. They are not reckless participants. But even sophisticated actors operate within constraints. If sourcing physical metal becomes competitive and expensive, their cost of maintaining naked exposure rises. Short covering into strength is not capitulation. It is risk control. And when multiple actors engage in risk control simultaneously, price can move faster than fundamentals alone would suggest. At the same time, large funds that have survived 6 margin hikes are signaling something through their persistence. They either believe structural deficit supports higher long-term pricing, or they require metal for strategic allocation. In both cases, their time horizon is not intraday. This creates asymmetry. Shorts operate under deadline pressure as first notice approaches. Committed longs can afford patience. Now expand the lens beyond March. May already carries more open interest than March did at the same point in its cycle. If March deliveries meaningfully reduce registered inventory, May begins with less cushion. Even if March resolves cleanly, the underlying inventory trajectory does not reset automatically. The warehouse system has been trending lower for months. That is not speculation. That is data. A multi-year structural deficit in global silver production compounds quietly. Annual consumption exceeding supply by modest margins gradually erodes buffer stocks. The futures exchange is not isolated from that reality. It is connected through deliverable categories. This is why history must be reframed carefully. In past episodes, extreme price moves were often accompanied by surplus conditions or concentrated speculation. Today's environment includes persistent industrial demand growth tied to technological applications. The context is different. Could the exchange impose new rules if volatility intensifies? Yes, it has that authority. But rule changes do not create supply. They only change participation mechanics. If participation is constrained while physical tightness persists, price suppression can temporarily calm screens while deepening off-exchange competition. There is also the matter of perception. Financial markets operate on layered trust. Retail participants trust brokers. Brokers trust clearinghouses. Clearinghouses trust warehouse reports. Industrial users trust that a futures contract equals deliverable metal. If any link weakens, behavior adapts. Trust rarely disappears overnight. It thins. Between now and the delivery window, every daily report becomes a data point in that thinning or strengthening process. If registered inventory stabilizes or rises, confidence rebuilds. If open interest collapses decisively before notice, pressure dissipates. If margin policy remains unchanged and price stabilizes, the episode may pass quietly. But if inventory continues falling, if open interest remains stubbornly high, and if price accelerates into the deadline, then the market is signaling that resolution will not be entirely routine. And here is where the practical reframe matters. Instead of asking whether silver will hit a specific price, ask what function the price is serving. Is it encouraging voluntary liquidation, or is it rationing scarce supply? Instead of debating daily volatility, observe incentive alignment. Who benefits from calm? Who benefits from stress? Who has flexibility? Who operates under time constraint? Futures markets are time-sensitive instruments. Physical ownership is not. If you hold physical silver outright, your exposure is not governed by margin increases or notice dates. You are outside the leverage loop. That does not guarantee price appreciation, but it does remove structural deadline risk. Inside the exchange, time compresses. Outside it, time expands. This distinction is not ideological. It is mechanical. We are approaching a point where calendar mechanics will reveal whether the imbalance is manageable or escalating. The exchange does not need to default to experience strain. It only needs to encounter enough friction that behavior shifts. Watch for subtle signals. Watch whether registered inventory sees unusual inflows just before delivery. That could indicate emergency sourcing. Watch whether open interest reduction accelerates sharply at the last moment. That would suggest capitulation. Watch for policy announcements framed as routine adjustments that appear unusually timed. The most important development may not be a headline. It may be a data slope that deviates from expectation. If silver breaks decisively higher while open interest remains elevated, the covering dynamic intensifies. If silver stalls while open interest collapses, equilibrium may be restored. Either path teaches something about the architecture. Markets teach through stress. And here is the unsettling question that remains. What happens to a pricing system when the participants inside it begin to doubt that claims convert cleanly into the underlying asset? Not in theory, not in legal language, but in practice. If that doubt grows, does price remain a reflection of supply and demand? Or does it become a negotiation between paper promises and physical scarcity? We are close enough to the mechanism now that we do not need speculation. We need observation, inventory, open interest, margin, price. Those four metrics will tell the story. Not commentary, not excitement. 5 days is not long in calendar time. But in leverage markets approaching delivery, 5 days can redefine assumptions that have lasted for decades. The structure is being tested. The only question is how much pressure it can absorb before behavior changes in ways that cannot easily be reversed.